What is up, everybody? Investing Club here, back with another video. And over the past couple of days, we've had some crazy news come out that the futures markets are pricing in negative interest rates. And in this video, I'm going to take you through this article talking about the Federal Reserve, why they may or may not move to negative interest rates, and why investors are pricing in negative interest rates, and how that will affect the US economy and what that will mean for you as an investor. So before we get started, smash the thumbs up button for the YouTube algorithm. It helps push out my videos to more viewers, and as always, I appreciate the support. So now let's get into it. I have this article up from the Wall Street Journal. Then this article talks about the Federal Reserve saying that they're not likely to cut interest rates to a negative percentage. Now, there's been talk of this for some time. So first, what are negative interest rates? If you don't know, a quick summary: negative interest rates that the lender of debt is guaranteed to lose money. So for example, an example of negative interest rates would be if you bought a US bond for $100 and next year you were guaranteed to get $99 back, which means you are guaranteed to lose money if you are a lender. And you might be thinking, well, who would want to do that? That would be crazy. Why would you want to be guaranteed to lose money? And there's a couple of reasons for that. First, negative interest rates usually happen in times of extreme economic uncertainty. And in the eyes of a lot of investors, it's better to have a guaranteed 1% loss than a potential 20% loss if you were invested in the stock market. Another reason it would make sense to invest in negative interest rate bonds are if you think that interest rates will go even more negative or fall even more. Bond prices and interest rates move inversely. And so if you think interest rates would go down even further when they're already negative, then you could see an increase on the price of your bonds. In this way, that in some of the countries that currently have negative interest rates, some of the bond funds there are having the best years they've had in decades. A lot of these bond portfolio managers have seen gains of 30%, 40% over the past couple of years, which is pretty much unheard of for managing a portfolio of bonds. But it is just because the interest rates have been dropping so much that the value of the bonds that they hold are increasing. Okay, so let's talk about the article. The Federal Reserve still see negative rates as a very last resort. So it doesn't seem like the Federal Reserve is excited about the possibility of negative interest rates. Again, they're worrying about the harmful effects on the financial markets and the banking industry, which would have very serious consequences. Now, the Federal Reserve says they prefer to stimulate growth, which means purchasing securities, which is expanding their balance sheet, which they have done. So the Fed has basically denied that they're even considering negative interest rates. You could believe them, but the thing is, the Fed has already started doing things they said they would never do. Right? A couple of weeks ago, they announced that they would be buying junk bonds. If you told someone a couple of years ago the Federal Reserve would be buying junk bonds, people would think you're crazy, right? There's no reason that would be happening, except right now, the economy is on life support, and, the Fed is taking all the action they can, and negative interest rates is something they could do. Instead of listening to what the Federal Reserve says and using that to predict if negative interest rates will happen, it's better to look at the federal funds futures. And these future contracts are what investors are pricing in terms of where interest rates will go. And I'll tell you, the federal funds futures are a lot more accurate than what the Federal Reserve says, right? You can never trust what the Federal Reserve says. They've already been doing things they say they would never do. So who's to say they won't do this now? So I'll put the link in this website in the description if you want to look at it more. And basically, we have all the futures contracts for every month. And coming down to March 2021, April 2021, and May 21. All of the futures contracts over 100. And what does this mean? Well, the futures contracts being over 100 signals that interest rates are expected to go negative. And so that's in 2021. However, a few days ago, even at the end of December, we saw that the futures went over 100. We can take a look at this at the chart for December. And this is for the contract for December 2020. And we can see in the past few days, the futures contracts have been over that 100 level. So as of a couple days ago, the market was pricing in negative interest rates by the end of this year. Now, that's pretty crazy to think about. And you might be thinking, well, how will the stock market react to negative interest rates? Will it help push the market up, or will it cause another stock market crash? And that is a fascinating question that I don't know the answer to. Right? On one hand, with negative interest rates, that really discourages people from saving money, because if you put money in a bank account, you're going to be losing money instead of gaining interest. So what a lot of people think is people that have money in the bank will be almost forced to invest that money into the stock market because they don't want to have a guaranteed loss every year. But another thing to think about is the market has been pricing in negative interest rates, and we've seen the massive run in the stock market over the past couple of weeks. We've really gone up off those lows in March. And a reason for that could be the expectation of negative interest rates. So now the question is, if the Fed doesn't go to negative interest rates like they said they would, well, then how will the market react to that? If they've been expecting negative interest rates and now we don't get any, will that have an adverse reaction on the stock market? If you're someone that doesn't want negative interest rates, here's the thing. Interest rates have been negative for years. Not in terms of the interest rate that you see in your bank account or that you see on the treasury note rate. When you look at the real rate you're getting in terms of inflation, we know that inflation averages about 2% a year. And so if you buy a US bond that pays 1%, the interest rate is negative. If the inflation's 2% a year, you're losing 1% a year on that bond in real dollars, regardless of whether the Federal Reserve actually moves to lower interest rates into negative territory. Just know that your bank account or any bonds you own that you've purchased recently likely are negative in terms of real dollars. So what would happen to the US economy if we had negative interest rates? Well, we can take a look at the 5 countries that have negative interest rates currently. There's Denmark, countries in the Eurozone, Switzerland, Sweden, and Japan. So first, Japan, negative rates have not stimulated the economy in Japan. As you know, if you don't know, Japan's stock market is a mess. Japan's stock market reached an all-time high in the 1990s and have not been to that level since. So I don't think low interest rates are working in Japan. Now, the Eurozone is sort of in a mess right now, and there's no real indication that negative rates have had a positive effect. Sweden's seen massive depreciation on their currency, and it has driven inflation up. And Switzerland is probably the only country that has actually seen some positive effects from negative interest rates. And the reason for that is because they protect the consumers. Personal savers, if you are someone that has a bank account, that rate wouldn't necessarily be negative. But again, I think to note is Switzerland is a very unique country, and the United States would probably not be able to replicate the success that Sweden had. So what are some of the things that negative interest rates do? Well, they can create new bubbles. In Denmark and Sweden, it caused a huge bubble in property prices because now with negative interest rates, you can get mortgages with negative rates. So that means you're basically borrowing the money. That basically means you're borrowing the money for a mortgage for free, or you're even getting paid to do it. And so with that, a bunch of people go out and get mortgages and buy properties, driving up the value of houses. And you can look at an increase of house prices as a good or a bad thing, depending on who you are, I guess. If you own a house, it's a good thing. In a lot of places, U.S. real estate is already way overpriced. And if we saw that go up even more, I don't know if that would be necessarily a good thing. Another effect, it would be the effect on the financial sector and banks. Because as I've said in my video on why Warren Buffett likes bank stocks, banks do well when interest rates rise because they make money based on the spread between the money they lend out to the customers and the money they can get investing at the higher interest rate. And so when interest rates go negative, this really limits the bank's ability to make money on the interest rate spread. If you follow my channel, you know I own Bank OZK, and negative interest rates would probably not be the best for them. And so if you own any bank stocks, that's probably something to keep in mind. Banks will likely suffer in the event of negative interest rates. But that's pretty much it. We're in crazy times right now, and this is definitely unprecedented. So we will have to see how this all plays out. It's fascinating, really, how this has unfolded, and we will see. Let me know in the comments if you think we are going to negative interest rates and what that would mean for you. If you learned something from this video, hit the thumbs up button, subscribe to the channel if you haven't already. I post videos like this multiple times a week, and I will see you on the next video.